Welcome to our training session covering Part 6 of the 2025 Tax Guide. Today, we have a substantial amount of ground to cover to ensure we maximize eligible deductions and accurately calculate offsets for our clients. We will be diving deep into the administration of student loans, the strict eligibility principles surrounding self-education claims at item D4, the mechanics of calculating adjusted taxable income, ATI, and the specific criteria for both the invalid and invalid carer tax offset and the zone and overseas forces tax offset. Let's get started. Our first topic is study and training support loans. There are several active government loan schemes, most notably the HELP program, which encompasses HECS, FEE, OS, and SA HELP. There are also loans for vet students and apprentices. It is important to know that for the 2025 calendar year, there is a combined borrowing limit of $126,839 across most of these schemes, though medical, veterinary, and aviation students have a higher limit of $182,172. Clients often ask when and how they must repay their student loans. Compulsory repayments are triggered when a client's repayment income reaches the threshold, which is $54,435 for the 2025 year. Note that repayment income is broader than taxable income. It adds back things like net investment losses and reportable fringe benefits. We must also look out for exemptions. If a client is exempt from the Medicare levy or receives a low family income reduction, and they have a spouse or dependents, they do not have to make a compulsory loan repayment. Furthermore, clients living overseas are not off the hook. They must declare their worldwide income and make repayments if they exceed the thresholds. Looking ahead to the 2026 tax year, the method for calculating compulsory repayments is fundamentally changing to a marginal repayment system. The minimum threshold will jump significantly to $67,000. Under this new system, repayments for those earning under $179,286 will be calculated only on the portion of their income that exceeds the threshold, rather than a flat percentage on their entire income. Additionally, any study and training loans existing on June 1, 2025, are eligible for a 20% reduction on the loan amount before indexation. Moving on to deductions, specifically item D4, work-related self-education. The Australian Taxation Office applies strict principles here. For a course to be deductible, it must directly connect to the client's current job. It must maintain or improve their specific skills, or it must be likely to lead to a pay increase within their current role. Crucially, we must exclude expenses if the study is designed to get the client a brand new job, even if that new job is with the same employer. We also cannot claim expenses incurred while the client was unemployed or not working in that specific field. When calculating the actual claim for item D4, be mindful of what is and isn't allowed. Full fee-paying tuition is deductible, even if deferred via a fee help loan. However, if the client is in a Commonwealth-supported place, their HECS help student contributions are never deductible. Travel directly to and from a place of education is claimable. If a client buys a laptop used 40% for study and 60% for private use, we must apportion that decline in value accordingly. And remember, clients receiving OSTUDI or youth allowance cannot claim study deductions against those specific government payments. Many offsets rely on an income test based on adjusted taxable income, or ATI. ATI is much broader than taxable income. To calculate it, we take the taxable income and add back reportable super contributions, adjusted fringe benefits, tax-free pensions, target foreign income, and critically, we add back any net rental property losses or financial investment losses. If the client pays child support, we subtract that amount. Understanding ATI is essential because it determines a client's eligibility for several beneficial offsets, which we will look at next. At item T5, we have the invalid and invalid carer tax offset. This is a non-refundable offset worth up to $3,300 for the 2025 year. To claim this, the client must maintain a qualifying dependent, like a spouse, parent, or adult child, who receives a specific disability or invalidity pension. Alternatively, the offset applies if the dependent is providing full-time care to someone on one of those pensions. Strict ATI limits apply here. The taxpayer's ATI cannot exceed $117,194, and the dependent's ATI cannot exceed $13,482. Furthermore, if the client or their spouse receives Family Tax Benefit Part B, they are locked out of claiming this offset for their spouse entirely. Finally, we address the Zone and Overseas Forces Tax Offset at item T4. This offset provides tax relief to individuals living in isolated areas or serving overseas. The critical rule to remember here is the 183-day rule, combined with the usual place of residence test. A client must reside in a qualifying zone for more than half the year. The ATO is very strict about this. If a client is a fly-in fly-out worker who spends 8 months of the year at a mine in a remote zone, but their permanent family home is in a non-zone city like Brisbane, they are completely ineligible for this offset. For those who do qualify, the offset amount varies depending on whether they are in Zone A, Zone B, or a special zone, and is increased if they have eligible dependents.